you tired of searching for reliable, high-yielding dividend stocks? Do you want to earn consistent gains while receiving a steady cash flow? Today's your lucky day. Welcome to the Golden Touch, and we're here to tell you to look no further than SCHD, the king of dividend funds. With SCHD, you can invest in a diverse portfolio of high-quality companies with a proven track record of consistent gains and dividend cash flow. So whether you're a seasoned investor or just starting out, SCHD is the perfect addition to your portfolio, and we'll tell you exactly why. First things first, the fund strategy focuses on investing in companies with strong financial health and sustainable dividend payouts, providing investors with reliable returns over the long term. But that's not all. SCHD's low expense ratio and tax-efficient structure make it a cost-effective choice for investors seeking to maximize their returns. Plus, with regular dividend payments, you can reinvest your earnings and watch your wealth grow over time. Smart, right? Also known as Schwab US Dividend Equity, it's the financial tool that gets the job done right. A dividend ETF like this one can be a valuable addition for beginning investors to their investments. But wait, let us explain what it's all about first. Dividend stocks are appealing because they are frequently high-quality, profitable businesses in addition to the passive income they offer. For a low expense ratio of 0.06%, an ETF like the Schwab US Dividend Equity ETF offers a broad exposure to 100 of the best dividend-paying stocks in the United States, providing a portfolio with instant diversification and income. Even seasoned investors with sizable portfolios can gain from adding SCHD to their holdings to get quick access to a variety of the best dividend companies in the United States. Also, dividend stocks can support a portfolio during a difficult market climate, so it's a safe and great option for all. For instance, the S&P 500 and NASDAQ 100 both experienced declines in 2022 of 19.6% and 33.5% respectively. With a loss of just 3.2%, SCHD fared much better than the market as a whole because of its collection of defensive, stable, dividend-paying businesses. It's currently one of the biggest and most well-liked dividend ETFs on the stock market, with $47 billion in assets. In fact, SCHD's goal is to closely mimic the return of the Dow Jones US Dividend 100 Index. It's appealing because it has a very low expense ratio of 0.06% and a present yield of 3.4%, which is higher than the S&P 500's average yield. What's more, not only does SCHD offer a competitive yield at the moment, but the ETF also increased its dividend payout for 10 years in a row and has increased it at an impressive rate of 13.7% compound annual growth over the past 5 years. Let's talk more about SCHD holdings now, shall we? You see, SCHD hasn't changed much so far in 2023, trailing the overall market. But it did beat the market last year, rising 3.6%. If we're talking numbers, SCHD has yielded 73% over the last 5 years, and it's generated a 137% return over the last 10 years. Plus, SCHD has returned an impressive 186% since its start in 2011. Now that's something, huh? With 101 holdings, this $47 billion ETF is well diversified, with the top 10 stocks accounting for 40.3% of assets. Large, well-known American dividend companies that are familiar to most investors, such as Verizon, Coca-Cola, Pepsi, and Home Depot, are among SCHD's top holdings. Impressive resume too, no? For a small fee, investors can access a great selection of prestigious U.S. dividend companies through the Schwab US Dividend Equity ETF, which also offers a very attractive dividend yield. Like many of its top holdings, say Broadcom, Texas Instruments, Coca-Cola, and Pepsi, this ETF's annual payout is gradually rising. As a rule of thumb, you should invest in companies that are increasing their yearly dividend payouts because this indicates that they're also most likely increasing their profits and cash flow and that their stock prices will likely rise over the long term. Are you liking this video so far? Make sure to drop a like and subscribe for more hacks on maximizing your cash flow. Now, basically, a modified market cap weighted portfolio of dividend companies with strong fundamentals is created by the Schwab US Dividend Equity ETF. In fact, this fund received a Silver Morningstar analyst rating due to its careful construction and reasonable charge. As we mentioned, this fund completely replicates the Dow Jones US Dividend 100 Index, which includes 100 stocks that have paid dividends for at least 10 years running and have the financial stability to keep doing so. Most of these top assets are well-known brands in the market, like Pfizer and PepsiCo. The index searches the entire market for its constituents, but value companies are favored because yield is taken into account when choosing stocks. The risk can rise when choosing stocks solely based on yield, but the fund's basic requirements keep it out of trouble. The fundamentals-driven strategy of this fund encourages a long-term yield because companies with sound financial foundations are well-positioned to maintain dividend policies. Plus, it enables the fund to capitalize on the quality factor, which has traditionally been associated with outperforming the market. Now, things like the Russell 1000 Value Index, the Morningstar category benchmark, are easily surpassed by the fund's profitability metrics, such as return on invested capital. Since dividend-oriented businesses with strong balance sheets are typically better protected from market fluctuations, this fund typically adopts a defensive posture. By allocating company weight based on market capitalization, this portfolio effectively captures the opinion of the market as a whole regarding the relative worth of each stock. But the fund adopts a modified strategy, capping the weights of each company at 4% of the portfolio and each sector at 25%. Lean portfolios like this one are susceptible to concentration, but these steps help the fund maintain its diversification. If you're looking for solid reasons to invest, hear us out. SCHD has a solid history of increasing reward payout. Even as COVID broke out in 2020, SCHD registered a 10-year streak of growing distribution since its launch in late 2011. Even more impressively, SCHD was able to increase its payout per unit compared to the previous year despite a difficult 2022. What does that mean? Say, if you made a one-time $1,000 investment in SCHD in January 2012, your yearly dividend would increase from $31.30 in 2012 to $113.88 in 2021. And why is that huge? Because your dividend yield from a $1,000 investment would increase from an initial 3.13% in 2012 to 11.39% in 2021 if we were to translate the dividend sum to yield on cost. No, it doesn't sound too good to be true. It really is that great. The word we'd use would be exceptional. And SCHD is exceptional, not only for its long history of increasing payouts, but also because it's performed well generally over the past 10 years. With a 10-year annualized return of 13.40%. And get this, the 10-year annualized return of SCHD was even higher than that of the S&P 500, which posted a return of 13.10%. In addition to the main factors we've just gone over, SCHD also generated returns with somewhat reduced volatility than the stock market. Analysts calculated the stock's volatility by comparing it to the market as a whole. With a 10-year beta of around 0.9 as of 2022, SCHD is roughly 10% less unpredictable than the S&P 500 over the same period. In other words, over the past 10 years, people who invested in SCHD have benefited from high returns without having the same level of volatility as the market as a whole. How does it do that? You can breathe a sigh of relief knowing that the kind of stocks that SCHD holds has a big impact on its comparatively low volatility. And they're very careful about their selection process. So, how do they determine which companies to add? Well, the Dow Jones US Dividend 100 Index is tracked by SCHD. And basically, these factors are used to select stocks. First, minimum of 10 years of uninterrupted dividend distributions. Then the size of the business, which needs to be a minimum of $500 million float-adjusted market cap. After that, they come to liquidity, which needs to be at $2 million and minimum 3-month average daily trading volume. That's not all though. There's more boxes to check to further rank the qualified stocks. Things like return on dividends, growth of dividends over 5 years, and financial stability of the company. Oh, and they also look at return on equity. As a result, businesses with greater weighting in SCHD holdings are typically more qualified and have solid financial standing and a history of dividend payout. In our opinion, long-term investors with a time frame of at least 10 years who are looking to invest for a steady and dependable stream of dividend income would do well with SCHD. It's also great for dividend investors seeking stable and diversified exposure to the US equity market. So why wait? Join the thousands of investors who trust SCHD to deliver consistent gains in dividend cash flow. Let us know in the comments if you'd like to know more about SCHD. See you next time.